Hi, this is John from Options Trading Pilot, and today I'm going to walk you through a simple bull put spread. So our site is Options Trading Pilot. What we do is we trade daily. We post our videos out once a week, but we post daily and in a discussion board called Discord. So take a look at our site. We're transparent and we really do follow this. We're honest, direct, distinct, and well-defined. We try to trade mechanically. And then these are the two of us, myself and my business partner, Guillermo. So let's take a look at Tesla as an example today. We're using the Tastyworks platform. I like that quite a bit. So let's say, first we look at Tesla. Let's look at the stock itself. So stock is bounced around quite a bit, as you know, 1200 down to 900 in that range. So there's an IV rank, which is the implied volatility rank of 34. And what you can do is you can see here that what we try to do is go about 45 days out, days until expiration. We could go out to February here, but I don't want to hold this at earnings, and that's what this little E means. So we'll stay within the 31 days, but mechanically we would have this off our books in 10 days or less, depending on how the trade goes. So you can see that there's an expected move of 122 points, plus or minus, from the 917. So an IV rank, we try to be over 20. If we're selling credit, if it's under 20, we'll do a debit spread, but generally we like to be credit or premium sellers. So coming out to January, this brown mark is the expected move. So let's say I'm bullish on Tesla. I could go out and buy the stock, but if I bought 100 shares, 100 times this is $91,000 of capital. So not always the best way to trade short or long term is to buy the stock, but you can get some of the same benefits with much less buying power. And I'll show you what I mean. So let's say I'm not saying this is not a trade recommendation, this is just an example. But let's say I want to do a 10 wide. Let me start with this to show you the difference. So if I want to sell the 850 put, so what that means is I'll make money if Tesla is above $850 at expiration on January 21st. And right now I'm getting, I can sell this to somebody, let's say for about 33, somewhere in between these two. So that'd be $33 per 100 contract. So, or a max profit here of 3,300. The problem with this is my max loss is 81,000, which is the stock price down to zero, less what I received in a credit. Now your buying power, it would cost me 29,000. So yes, I don't have to put up 92,000, but in this particular trade, it would cost me 29,000 in buying power or margin. So what you can do, since most people don't want to trade like that, is I call this buying insurance. And so yes, it'll cost me $29 out of that 32 to buy the insurance, but you can see here what happens is now my max profit is $315 or $310. That's the credit I received between the two, but my max loss is around 690, 700. And so, and my buying power is essentially the max loss in this case, so about 690, 685. So this is a lot easier trade to put on. And then you can see over here the percentage, the top percentage of profit is 64%. So that gives me a fairly good trade. If I want to move it down, say 800, my pop will go up to 75%, but then my max profit versus my max loss, the ratio will be a smaller gain and higher loss because I'm moving further away from the money. And at the money, when you hear about that, at the money is 920. So these are essentially the at the money options at 920. So delta is a key piece here. Delta gives me essentially the implied volatility chance that an 800 strike would be breached between now, real time, and January 21st. So right now there's a 19% chance that Tesla will be under 800. As an example, if I move up here to 920, there's a 47% chance, or say 50-50 chance that the stock will be under 920 by January 21st. And that's just based on the historical and implied volatility. So in a nutshell, if this is something that interests you, these are the types of trades we do all the time. Not saying this again is the trade we put on. There are other strategies. This would be a bull put spread because you essentially want it to go up or stay the same. You want to earn that credit. You can do a bear call spread, which is just like this, but it's on the call side and essentially want the market to go down or stay the same. Or you want your volatility to decrease. You can also make money with that, but that is on a more advanced lesson. So that's it for today. Simple. You can sell what's uncovered or naked, which is a large buying power. Or come in here and buy the insurance. While that does limit your profit, it also limits your risk. Thanks for listening.